Daily outlook for Friday, July 24th. Alright, yesterday, as anticipated, revisited discounted levels, in this case, making a new low of week here on Thursday. But you can see that the closure here left a rejection block, right? So, uh, did so most importantly inside the discount fair value gap of interest. It trades to 50%, leaves a wick behind. It actually ended up trading perfectly to 62% of this fair value gap. You can see that so far this level has been pretty sensitive. So for today's power of three, it's just going to be, well, we're trying to figure out if this wick is enough to send price higher inside the range. If that's the case, then in my opinion, we're looking at a drawn liquidity being the new day opening gap from yesterday, and if not, a new weekly high. Okay, and if price were to trade past these levels, you can target, say, 29,500, which is the high here of the discount order block from the previous monthly range. But so far, the market is proving that it's still using this PD ray as a bearish mitigation block, right? So if today is able to trade higher from this rejection at the lows, all depending on the closure, but if it were to close, say, above this series of down close candles, in my opinion, that would be very bullish for the market. I would anticipate from there to see either the last week of July or the beginning of August to be open, low, high, close. So those are drawn liquidity those are premium drawn liquidity. In terms of discount drawn liquidity, okay, if the market will continue trading lower from this trend, right, from the divergence that it created between the daily high of Tuesday and Wednesday with the S&P 500, then in my opinion we're looking at drawn liquidity being 75% to the low of the weekly discount fair value gap. Okay, we have to remember this is an important PD rate because it is located at 25% of the 3-month look back. Okay, you can see how sensitive it's been to price every time it's traded into it. Okay, so if the market will trade lower today, and we'll look at PD rays, right, and anticipate why the market should trade higher or lower. Again, 75, right, so we're looking at the range of 28,300 down to 28,000. And if the market were to trade past these levels, then we're looking at 27,800, which is the monthly BISI high, okay? Now, anything past that, I'm not sure would be realistic, right, already from where the market will likely open versus the most discount drawn liquidity. We're looking at a range of 3,005, 4,000 ticks. So I think that would be plenty, right? But the day would need to be some kind of classic sell day. Okay, it's probably not going to do it. It probably won't trade to this level, right? If it's any other profile, it would really need to be some kind of heavy classic sell day. Okay, we'll come back on this chart later. On the 4-hour chart, so the 3-week look back, we can see that price came from high of day made at 50% here of the bearish mitigation block located inside of the range, right? Price essentially fell to reclaim this level, okay, as a bullish order block. It tried to do so on the classic buy of Tuesday. Eventually Wednesday retraced, tried to expand higher, but fails at 50%, right? And yesterday's power of 3 high comes from 50% of this level. Price distributes from 50% down into discount, right, where we had the rejection block from the previous week, and you can see that 50% of this level is holding so far, and this rejection comes with a divergence with the S&P 500. Okay, so this can be, just as this was a narrative, right, coming inside the day of yesterday to see price trades from premium to discount. Well, this divergence at the previous weekly low also can be the same. Okay, to see price trades from discount up to premium levels. And we saw again in terms of premium drawn liquidity for today, we have the new day opening gap, the previous daily high, and then the weekly high. And if price were to trade past that, likely the range here of the order block high. I don't think price would expand past these levels. Okay, so we look at in between 29 to 29,500, say. Here there's a fair value gap inside of the range. This is going to be an important level. We'll look at that when we look at the 3-day look back. Alright, this is the 3-day look back. We can look at the phase of price delivery. Price comes from a classic sell to a New York reversal that failed to expand, okay, creates a divergence as we saw, and then has a bearish closure here. Right, and the open of today retraces, right, revisits a PD of interest here that we had identified, located at 25% of what was the 3-day look back. You can see that that's where the high of day is. You can see that its standard deviations were also accurate, right, as to today's daily profile. As we saw, we had a discount array. Price ended up revisiting these levels, right, and you can see how price found sensitivity here, and this is one of the reasons why I was saying if New York is to open low inside of the range, I'm not going to be too comfortable shorting this, okay, because it's never easy to displace such a large wick, especially that price came from expansion. All right, the pre-market session here was also an expansion, okay. It's not like it's not like the pre-market session was a consolidation phase that was preceded by expansion. In that case, I would have less of a problem looking for shorts inside the opening range or 10 a.m. But the fact that it didn't do it, right? Yes, it still delivered lower, but it was very high resistance, okay? And ranges being pretty large here. Obviously, the narrative to short was there, but what I'm saying is it's not low resistance, okay? It's not so easy to determine where to put your stop loss. You need to survive the shakeouts, you need to survive the chop in here before price goes to your targets. And even when it does, right, say you're anticipating for range low to be traded to, you can see that price fails to trade there, right? So builds high resistance in here. Okay, so we said expansion to an expansion that failed, right? So here providing a reversal, and today providing a continuation of this reversal here, right, of the bearish closure. But just like we looked at this closure here, right, which was the closure of overall what was an anticipated bullish daily profile, right, or at least a bullish template here being the New York reversal profile. Well, bullish New York reversal profile, but price closed bearish. Well, we kind of have the same thing here, right? Price delivering as, personally I would consider this a sell day. You could consider this a Z day, but I won't personally, because overall, right, the opening range and early 10 a.m. expanded lower. So because of those reasons, I would consider this a classic sell and not a Z day. Now, if from the opening range price would have consolidated, then I would have labeled it a Z day. All right, and what you can see from this sell day is that the closure of it was bullish. What happens at the closure here, or at least near the closure, right? Starting from lunchtime up to the PM session, price creates a divergence at the previous weekly low. Price respects 50% of the discount wick, and then price creates a change in state of delivery here, right? You can see that there's expansion. If you were to look at the 2 p.m. profile, open, low, high, close, right? So in my opinion, there's some kind of range to expansion profile here. Okay, so basically translated to being an expansion profile. So I do believe that at the open, price should continue from these levels. Now, if you want to determine if the drawn liquidity for today will be the new day opening gap from yesterday, the previous daily high, the current weekly high, or will it be 75, 100%, right? So the low of the weekly discount fair value gap, or even potentially the monthly fair value gap high. we need to analyze what's inside of this range. Now, yesterday we analyzed the 3-day look back since the range of Wednesday was relatively tight compared, say, to the classic buy. But in this case, we have had a classic sell here, so it will be enough for me to be able to determine where the daily high or low can form simply based on this range. All right, so at the highs, we have the high, right? 75%. You got the range of, right, you got this big order block, which is the main order block in my opinion. You got a couple fair value gaps around it. Personally, what I would use the range of, since it's right in the middle of, say, these many order blocks, or this SIBI or this SIBI here, right, which is a balanced price range. Personally, I would use this. I would use the new day opening gap. Right, it is located around premium of the range, right, 75%. So you can see that price has been sensitive to these levels, right? Traded above it, creates a high of day, and then breaks it, right? So reclaims it, and then reaccumulates into it. Okay, so again, now this level for me is not useful in terms of an open high-low close anticipation, right? I don't think price should do this, but it is useful to me as a draw on liquidity, and also can be useful to me to gauge order flow if the drawn liquidity is even higher than that, right? Say price expands above it, reaccumulates into it, to then keep trading above. Okay, this is what this level is useful for me. The main PD rate that I'm interested in is the one that's located at 50%. To me, that's the one that should be able to tell me if price will continue trading lower or if price will be drawing towards premium level. Okay, now if we look on the 4-hour chart and we see what's located inside of this range, you can see that there's a large 4-hour fair value gap cutting right through these levels. Okay, we have a volume imbalance in premium of this 4-hour fair value gap. I don't believe we have one in discount, so I'm going to be identifying it like this. We'll come back to these levels soon. At 25%, you can see that there's an inverse fair value gap here. You got a large rejection block right inside the range, which is currently a bullish mitigation block here. Right, price went from the lows to highs, failure to make a lower low, and then trades above. But I saw on the 15-minute, there's a pretty interesting PD rate here, which is the expansion from the PM session. Okay, and although the volume imbalances in here are pretty small, right? They're pretty tight. This level is technically a suspension block. You can see you got volume imbalance in premium, volume imbalance in discount as we looked at. So I'm going to be interested in seeing how this fair value gap holds. We obviously have, right at the low here, we have the range of a large rejection block, such as we had here. Okay, so I do think that here, obviously, let me mark out this. Whoops. I'm going to be marking out the sell side liquidity, which is the low of the range, right? But again, the low of the range comes with a large rejection block. So what I'm going to do is I'm still going to identify this level, but I'll remove, to not confuse myself with having too many levels on my chart. I'll simply keep 25, 50, 75, or I could simply keep 50% of this level up on my chart. Okay, just to get an idea of order flow. For the moment, I'll remove the range here of the premium array. Again, what I'm mostly interested in is seeing the PD rate here located at 50%. To me, if 50% of this PD rate here, you can see that there's a fair value gap right through it. You can see that there's a bearish mitigation block right through it, right? This is at 50% of the 4-hour fair value gap. If price is able to inverse these levels, right, inverse the fair value gap, then I do believe that the drawn liquidity should be the new day opening gap and the previous daily high. If not, if price will fail at these levels, obviously it will depend the time of day, okay, because it can be that price does this, can be that price also does this, right? But if price were to fail inside the fair value gap at 50%, then I would anticipate very likely to see, right, for price to come back inside the rejection block. Okay, then obviously could keep trading lower, but if price were to do this, okay, and New York reverses, then ideally I would like to be short on the right side of the curve, but I wouldn't want to target range low again, because price could be still high resistance once it trades back inside this wick or this wick, right? So my drawn liquidity would probably be the high of the wick here, right? My low hanging fruit drawn liquidity. Okay, let's do a quick recap. We saw yesterday that price came back inside discounted levels as anticipated because of the divergence between the high of Tuesday and the high of Wednesday. But now that price has traded in discount, you can see that it is still rejecting at 50% of the weekly BISI. It also created a divergence with the previous weekly low. So the idea that I have for today's profile, or at least power of 3, is I want to understand if price will be coming back inside the range. If that is the case, I'm trying to target the new day opening gap from yesterday, the previous daily high, and then a new high on the week. Past that, the max where I think it should reach would be around 29,500, which is the high here of the discount order block from the previous monthly range. If not, right, if price will continue trading lower from this trend, or we get an open, high, low close, then I do believe that important drawn liquidity for the day can be 75%, right? So the lower half here of the weekly BISI, and if price will expand past that, then I do think that the high of the monthly fair value gap, right, so 27,850 or so, can be a good drawn liquidity, a good discount drawn liquidity. 4-hour chart, we saw, I mean, the daily chart is basically telling us the same thing here. Price moved from 50% down into discount, has traded inside the discount array, has created a divergence, and is respecting 50% of the wick. Okay, so right, again, from here I'm trying to understand, can the market inverse this fair value gap, right, to trade back towards these highs, or at least towards premium of this range, say 50%. We have the new day opening gap, we have the previous daily high, and then right a bit above that, that's 75% here of the bearish mitigation block, we have the current weekly high. Okay, so does price do this, or does price do this, right? Something like that. Okay, and then 3-day look back. We analyzed the phase of price delivery. We saw that price here yesterday comes from an expansion lower, but we saw that price also left a rejection right at the low of day and saw an expansion at its closure. So because of that, I do anticipate that price should come back towards some kind of premium level, okay, just like we anticipated yesterday for price to come back inside discounted levels because of the divergence. Price, in my opinion, should do the same today. And then it's going to be a matter of when you come inside the New York session to be able to understand the daily profile, right? Does New York open somewhere around this range after price fell at 50%? Or does New York open, say, inside this range? Right, in my opinion, then the best trade would be to look for a retracement inside the inversion fair value gap to trade out of it. Okay, so internal to external. We analyzed that. Right, we analyzed the previous daily range. We have the high, the low. We saw that the low of it here has a large wick, so I'm marking out 50% here just to get an idea of order flow. Now, if I come inside the New York session and New York is trading at these levels, in that case, I'll be putting up all the quadrant in case price were to retrace or reverse through these levels. But meanwhile, I'm keeping 50%. In discount at 25%, we saw on the 15-minute chart that price left a suspension block at the closure. So I do believe that this is an important PD rate. Asia, in my opinion, should continue trading higher from this PD rate, unless it opens and immediately starts trading higher. We saw 50% of the range. We have a large, we have a fair value gap cutting right through the range. We saw that this fair value gap has has a volume imbalance in premium. Look, if you don't want to add this volume imbalance because it's small, right, you could simply reduce the fair value gap down to, right, the actual inefficiency here in the middle of the range. But personally, I think I'll still include these, right, the inefficiency, because looking at on the left side of it, right, you got this large wick, right, and this 50% of this large wick happens to be around here, 75 to the high, right, of the fair value gap, but including the volume imbalance inside this fair value gap. So I think I will be keeping these levels. I will be keeping the fair value gap with the volume imbalance again, although it's a small volume imbalance, but it should nonetheless be significant in my opinion. And then we saw in premium, we have the range here. You got many PD arrays here. The range was kept pretty tight. You got a couple bounce price ranges. You got a couple order blocks. Personally, if price were to trade around these levels, then I will simply mark out the quadrants of yesterday's new day opening gap. Okay, and then I'm going to want to see how price trades at these levels. And obviously based, well, not based, but if New York were to open at around these levels, or even already trading above these levels, then I would like to see a New York retracement or consolidation phase located around these levels to trade towards a premium drawn liquidity. I was looking at maybe some standard deviations, but I don't really see nothing too obvious. I think that these were pretty clear because the breaker happened to be right at 25% here of the range, but in this case we don't have a breaker. Worst case, I think what we do have is a bullish mitigation block. It could be, if price will be bullish, maybe you could mark up your chart like this, or simply put up the standard deviation, right? You could put it from the low here of the failure swing up to the order block. This can be realistic for today's power of 3. I mean, you could even do this potentially, right, from the failure swing up to the mitigation block, which technically is the market structure shift here. It can be, if you're going to get some kind of buy day today, right, very likely price does something like this, it eventually stalls at these levels. Definitely a possibility. Obviously, all depending on how the quadrants at 50%, how the quadrants at 25%, how the quadrants at 75% are treated. That's what's able to give you your bias and your drawn liquidity. All right, I think that covers it for today. Good luck and good trading.